Hello, everyone. Welcome back to Sane Finance, and we're gonna talk today about inverted yield curves. What is an inverted yield curve? What's a yield curve? Why is everybody talking about the inverted yield curve? What does this inverted yield curve mean? And we're going to get into that right now. Let's find out. And who is this yield curve going to affect? The term yield curve refers to the relationship between the short and long-term interest rates of fixed income securities issued by the U.S. Treasury. An inverted yield curve occurs when short-term interest rates exceed the long-term interest rates. Under normal circumstances, the yield curve is not inverted since debt with longer maturities typically carry higher interest rates than nearer term ones. Now, from an economic perspective, an inverted yield curve is a noteworthy and uncommon event because it suggests that the near term is riskier than the long term. Below, we explain this rare phenomenon, discuss its impact on consumers, investors, yada, yada, yada. Obviously, I'm getting my information from Investopedia because I'm an idiot on YouTube and I'm a regular guy that made most of my money with dirty hands. I shouldn't be able to make money trading the stock market, but I do. And it's one of the reasons is because I am constantly learning and educating myself about things we all need to know if we're going to be successful in this area. So if you want to be more successful at your trading and stuff, then this is not financial advice. And I'm not suggesting you copy anything I do other than the fact that I research, learn, and educate myself. You can copy that in any way, shape, or form you want, and you will get better. But as far as copying my trades and stuff, please don't do that because I don't always make money. Unless, somehow magically you go back in time and copy everything I did the last 2 years, and then, yeah, I made money. But don't do that either. Interest rates and yield curves. And thanks to Investopedia for all this wonderful information. And James McWhinney, who writes articles for Investopedia. And of course, I'm not going to read the whole article because some of it is so boring. Oh, boring. I'm going to try to skip the boring parts for you so you can just find out the really good, juicy stuff. Typically, short-term interest rates are lower than long-term rates. So the yield curve slopes upwards, reflecting higher yields for longer-term investments. That means it's a chart that looks like a stock going up, but without so many of the heartbeats. This is referred to as a normal yield curve. When the spread between short-term and long-term interest rates narrows, the yield curve begins to flatten. And we've already seen that recently. A flat yield curve is often seen during the transition from a normal yield curve to an inverted one. Ooh, scary stuff, man. Because that's what we're in right now, inverted. But what does it mean? What does an inverted yield curve suggest? Well, historically, an inverted yield curve has been viewed as an indicator of a pending economic recession. Boom, boom, boom. Yeah, not good. Not good at all. So, when short-term interest rates exceed long-term rates, market sentiment suggests that the long-term outlook is poor and that the yields offered by long-term fixed income will continue to fall. So people, please be very careful with your money right now. Just like I've been saying if you haven't seen my other video on the top 10 things that are pushing this market down right now, the bear market, please watch that. Don't even mention the yield curve in that. And I had to put a bonus one in there because I already had 11 really, noteworthy negative catalysts that are pushing down on this market right now that you've got to keep in mind if you're looking at any stocks or ETFs or thinking about investing in anything right now, because you don't just need to do all the research on the individual stock or the individual ETF and have that in mind, but you also need to understand what's going on with the market as a whole, because it can affect that stock. Even like my Tesla right now is that just about the only thing I didn't, well, and I did sell a lot of the Tesla earlier this week, along with almost every stock I had. And if you want to know why, just watch that video. But yes, I have some more Tesla right now because, as Andre Jeek was saying, there's the dip, and sometimes you buy in the dip, but then there's the dip of the dip, and so you buy some more, and then there's the dippity the dip of the dip, and you're like, should I buy some more? I'm almost out of money, and then you buy some more anyway, and then it dips further, and you're like, I'm out of money. So you got to be careful. Got to be careful. This happens to all of us sometimes. Okay, more recently, this viewpoint has been called into question as foreign purchases of securities issued by the U.S. Treasury have created a high and sustained level of demand for products backed by U.S. government debt. When investors are aggressively seeking debt instruments, the debtor can offer lower interest rates. When this occurs, many argue that it is the laws of supply and demand, rather than an impending economic doom and gloom, that enables lenders to attract buyers without having to pay higher interest rates. So what I'm hearing from this is that inverted yield curve, probably a recession, but this paragraph would suggest that there's hope that maybe not recession. Maybe there are other factors. How much you can read into that, I don't know. I don't have enough experience in the stock market and investing, other than investing in real estate, investing in businesses that I owned directly, investing in all sorts of things like that, other than the stock market. Yes, decades of experience in that. But I didn't understand how much easier it was to invest in the stock market and how much cheaper it was to invest in the stock market until a couple years back when I started investing in the stock market, and I was making so much more profit off of that with so much less effort. Not that there's not effort. I mean, obviously, you and I both are making effort right now to learn something to do better trades. And that is effort. But man, I tell you what, I was doing burnt, bruised, and bleeding with a crew of guys, and for 8, 10, 12-hour days every day for years and years and years. This is a lot easier than that. I mean, inverted yield curves have been relatively rare, due in large part to longer than average periods between recessions since the early 1990s. For example, the economic expansions that began in March 1991, November 2001, and June 2009 were 3 of the 4 longest economic expansions since World War II. During these long periods, the question often arises as to whether an inverted yield curve can happen again. Economic cycles, regardless of their length, have historically transitioned from growth to recession and back again. Inverted yield curves are essential elements of those cycles, preceding every recession since 1956. Considering the consistency of this pattern, an inverted yield will likely form again if the current expansion fades to recession. Upward sloping yield curves are a natural extension of the higher risk associated with long maturities. In a growing economy, investors also demand higher yields at the long end of the curve to compensate for the opportunity cost of investing in bonds versus other asset classes, and to maintain an acceptable spread over inflation rates. Now, that sounds like a bunch of gobbledygook and big, heavy technical words. It seems to me what they're saying is that people who buy bonds and they're going to have their money tied up in that bond for a long time, they want to be compensated with a better return on the longer bonds because of, and you heard the word opportunity, because they had the opportunity during that long period of time to jump on this stock or jump on that stock and make a little money off of this stock or make a little money off of that stock. But they couldn't do it because their money was tied up in that bond. And so that was an opportunity cost. It cost them whatever gains they would have gotten from using that money for something else because they left that money in that bond. And if you have anything to add to anything I'm saying here at any point, please add it in the comments below, because there may be somebody out there needs to hear what you have to say, including myself. As the economic cycle begins to slow, perhaps due to the interest rate hikes by the Federal Reserve Bank, an upward slope of the yield curve tends to flatten as short-term rates increase and longer yields stay stable or decline slightly. In this environment, investors see long-term yields as an acceptable substitute for the potential of lower returns in equities and other asset classes, which tend to increase bond prices and reduce yields. The formation of an inverted yield curve. As concerns of an impending recession increase, investors tend to buy long treasury bonds based on the premise that they offer a safe harbor for falling equities markets, provide preservation of capital, and have potential for appreciation in value as interest rates decline. Now, this preservation of capital, if you don't know what that means, don't quote me on this because I am an amateur investor and I am not a financial professional, and this is not financial advice, but preservation of capital, as I understand it, is like if you're doing something with your money that protects it from losses like higher, inflation. Inflation, which we have a lot of right now. So people are looking for a way to preserve their capital without inflation eating it all up. All right. So, and have a potential for appreciation in value as interest rates decline. As a result of rotating, okay, I'm going to have to have a little coffee here because I'm derailed. I can't talk anymore. As a result of the rotation to long maturities, yields can fall below short-term rates, forming an inverted yield curve. Yeah, that scary thing. The scary thing we've been talking about this whole time. Since 1956, equities have peaked 6 times after the start of an inversion. And the economy has fallen into recession within 7 to 25 24 months. Now that's a very important metric right there. So the forming of an inverted yield curve, and since 1956, equities have peaked 6 times after the start of the inversion, and then the economy has fallen into recession within 7 to 24 months. Now, that's not me asserting this. It's not me trying to make you believe something. This is, you just go to Investopedia, read this article yourself, and you can find even more information, because I'm trying to avoid some of the really, really boring parts. And the article is entitled "The Impact of an Inverted Yield Curve." And kudos, I'd like to give a big shout out to James McWhinney for writing this article and putting all this information together in such a nice, neat package for all of us to be able to learn from. And I sure hope that he has done his due diligence and is very accurate in all this information. I do have a great deal of faith that he has been, because I've had really good luck with most of the stuff that I've learned on Investopedia. I trust this source. Let me check the chat real quick and see if I'm ignoring any of you guys. I don't want to do that. Bottle caps, good to see you here. 4 out of 5 investors suggest you don't take advice from a mechanic. You're not supposed to tell them I'm a mechanic. But yes, I have been. There's my master's certificate right there, one of them, and one of them for automotive and the other one for heavy duty trucks. So I've been outed. I'm just a grease monkey throwing money into the market and somehow managed to make money. Isn't that crazy? That's insane. It's insane that I've been able to do this. Wow. If I can do this, any of you guys can do this. So just remember that. If I can just go from turning wrenches all the time, learn enough this quickly to make money in the stock market, then there is hope for just about anybody to be able to learn enough to make money in the stock market. I would be very, very wary of going into the market right now, though. Very, very dangerous conditions right now. And if you want to hear about some of those conditions, check out my video on the top 10 reasons why we're in a bear market right now. It's already out there, ready for you to ingest and digest and use to help rescue you from mistakes. As the economic cycle begins to slow, perhaps due to interest rate hikes by the Federal Reserve Bank, the upward slope of the yield curve tends to flatten as short-term rates increase and longer yields stay stable or decline slightly. And we just heard from Chairman Powell, I think it was yesterday. It was just yesterday. And he reiterated what he's been warning us over and over again. He's been warning all of us, just warning after warning after warning on a regular basis, that he is going to increase interest rates, and saying that he's going to finish tapering first, and that sometimes there's reports of 2 bigger increases or up to 4 smaller increases of the interest rates during 2022. So it's coming. Unless for some reason he changes his mind, but I don't see that happening. What I think is going to happen is if anything, they're going to hurry that up and get that over with, because no matter what they do at this point, there's going to be more pain. And maybe they should just rip that Band-Aid off and get it over with, so the pain can go ahead and come and leave as quickly as possible. I mean, you can't get to the other side of of a you can't get to the other side of a muddy lake if you don't ever go towards it. Or if you just going towards it so slowly, you're just gonna be in trouble forever. What's that saying? When you're going through hell, speed the heck up because you want to get through it as fast as possible. Don't slow down. The formation of an inverted yield curve. Okay, I think we did that already. Inverted yield curve impact on consumers. Inverted yield curve impact on consumers. And in addition to its impact on investors, an inverted yield curve also has an impact on consumers. For example, home buyers financing their properties with adjustable rate mortgages. I never do that. I never get adjustable rates. So, if you want, I do have some videos about my real estate investing here. Maybe I should do some more. Let me know in the comments if you want to see more about my real estate investing. But I never do adjustable rate mortgages. And you may be finding out one of the reasons why here in just a little bit. Adjustable rate mortgages have interest rate schedules that are periodically updated based on short-term interest rates. When short-term rates are higher than long-term rates, excuse me, payments on ARMs, which is an anachronism for adjustable rate mortgages, ARMs tend to rise. When this occurs, fixed rate loans may be more attractive than adjustable rate loans. Lines of credit are affected in a similar manner. In both cases, consumers must dedicate a larger portion of their incomes towards servicing existing debt. This reduces expandable income and has a negative effect on the economy as a whole. Inverted yield curve impact on fixed income investors. So if you're on a fixed income, you might want to hear about this. A yield curve inversion has the greatest impact on fixed income investors. In normal circumstances, long-term investments have higher yields because investors are risking their money for longer periods of time. They are rewarded with higher payouts. An inverted curve eliminates the risk premium for long-term investments, allowing investors to get better returns with short-term investments. When the spread between U.S. Treasuries, a risk-free investment, and higher risk corporate alternatives is at historic lows, it is often an easy decision to invest in lower risk vehicles. In such cases, purchasing a treasury-backed security provides a yield similar to the yield on junk bonds, corporate bonds, real estate investment trusts, and other debt instruments, but without the risk inherent in these vehicles. Money market funds and certificates of deposits may also be attractive, particularly when a one-year CD is paying yields comparable to those on a 10-year Treasury bond. Inverted yield curve impact on equity investors. When the yield curve becomes inverted, profit margins fall for companies that borrow cash at short-term rates and lend at long-term rates, such as community banks. Likewise, hedge funds are often forced to take on increased risk in order to achieve their desired level of returns. In fact, a bad bet on Russian interest rates is largely credited for the demise of long-term capital management, a well-known hedge fund run by bond trader John Merriweather. Despite their consequences for some parties, yield curve There go losing my tongue again. This is to run off and do something else all by itself. Yield curve inversions tend to have less impact on consumer staples and healthcare companies, which are not interest rate dependent. Remember, none of this is financial advice. And I would be very careful about dumping money into consumer staples or healthcare companies right now, because there's a lot more factors going on right now than just the inverted yield curve. Check out my other video about the top 10 reasons why we're in a bull market right now to hear about some of those reasons. And consumer staples and healthcare companies, which are not interest rate dependent. This relationship becomes clear when an inverted yield curve precedes a recession. When this occurs, investors tend to turn. Oh, I'm sorry. It's getting boring. This is the boring part. I'm sorry. I didn't mean to be reading a boring part. Let's move on. Now, okay, here's some better stuff. Yeah. Some examples of what has actually happened in the past with the yield curve. In 2019, the yield curve briefly inverted. Signals of inflationary pressures from a tight labor market and series of interest rate hikes by the Federal Reserve from 2017 to 2019 raised expectations of a recession. Those expectations eventually led the Fed to walk back the interest rate increases. This inversion of the yield curve signaled the onset of recession during 2020. In 2006, the yield curve was inverted during much of the year. Long-term Treasury bonds went on to outperform stocks during 2007. In 2008, long-term Treasuries soared as the stock market crashed. In this case, the Great Recession arrived and turned out to be worse than expected. So that was 2006. That yield curve was inverted and foreshadowed all of that pain in 2007, 2008, 2009. But there was a lot of negative catalysts going on. Well, maybe not a lot in number, but they were really, really heavy negative catalysts that don't exist right now. And a lot of changes were made to make sure that those sort of things don't happen again. And so things are a little bit different, but the yield curve thing, not necessarily different. In 1998, the yield curve briefly inverted for a few weeks, and Treasury bond prices surged after the Russian debt default. Quick interest rate cuts by the Federal Reserve helped to prevent a recession in the United States. However, the Fed's actions may have contributed to the subsequent dot-com bubble. So the pain from that yield curve, from what I'm hearing here in layman's terms, because I'm a layman, so I can speak in layman's terms. What I'm thinking is what they're saying in this particular quote here is that 1998 yield curve inversion would have led to a recession if it wasn't for the Federal Reserve's actions, which didn't, and they're further saying here that didn't prevent the recession. It just kicked the can down the road a little bit until the dot-com bubble burst, And it all happened then together. Which, wow, I mean, we could research that and go over that situation and probably learn a lot of stuff to help, you know, foresee things going on in the now and the future. But again, that's going to be a situation where a lot of things happened that aren't necessarily ever going to come together in that perfect storm ever again. But maybe they could and manifest themselves in a different way. Maybe the new .com bubble burst could be a whole bunch of different tech things, like the thing they're hollering about with 5G, but with maybe 6G when that comes along, or something else. And it creates this euphoria around something else other than .com, other than website things. And you know, maybe that could be the next similar thing. And if we pay attention and we respect the yield curve inversion as a warning sign, maybe we can avoid some pain. So if, again, I would like to give credit to, let me see his name here, James McWhinney, for writing this article at Investopedia. And if you want to hear the rest of the article, which to me is just more boring stuff, I think we got the really good juicy meat out of it and the best, most exciting stuff. I'm sorry for the little bit of the boring that I did read. Apologize for that. But if you want to get it completely exactly the way he intended it to be read from beginning to end, just go visit Investopedia and look for The Impact of an Inverted Yield Curve by James McWhinney. Very good article. And it wasn't even written that recently. I think he wrote this in 2020, but the information is still very much applicable. And well, and it's even more important right now because of what's going on with the yield curve right now and the situation we're in with the stock market right now. Excuse me, I need another drink. I'm losing my voice here. Kyla Myers, how are you doing? Welcome to the chat. We are about to wrap up here. I am very happy to have been able to spend this time with you. And as always, I would like to wish each and every one of my insane friends insane growth and an insane amount of success. Just make sure you're careful right now in this market. It's a scary market.